Good afternoon. My name is Richard Dalton. I'm a partner specialising in VAT in the real estate and construction sector. I'd like to take this opportunity to thank you for joining us for this video webinar. In this section, we will focus on the forthcoming introduction of the VAT domestic reverse charge for building and construction services, often referred to by the acronym DRC. As many of you will be aware, the change was first proposed in 2017, and following consultation with various industry bodies and the publication of draft legislation and guidance, the DRC is scheduled to be introduced with effect from the 1st of October 2019. It will represent a significant change to the way in which VAT is accounted for on supplies of certain types of construction services to VAT-registered businesses. And while the change will necessitate an element of administrative change on the part of all concerned, my view is that the "so what" factor with this particular change to the way VAT is accounted for is its material impact upon cash flow and working capital within the construction sector. In order to better understand the impact of this change, it may first be useful to recap on the way in which VAT currently works in the construction sector. In common with most other industries, a UK-based supplier of construction services supplying standard rated services, those that are subject to VAT at 20%, to a UK-based customer will currently charge and account for VAT at 20% on its supplies. The recipient of those services, if it receives them in the course or furtherance of an economic activity that gives rise to the right to recover VAT, will then recover the VAT subject to the normal rules. This is a simple process which is common in all supply chains. So, what is the issue with the construction sector? The reality is that in the construction sector, the values at each stage, and therefore the corresponding VAT element, are of significantly greater magnitudes. This is a factor that HMRC believe makes the sector attractive to, and vulnerable to attack from, organised crime. HMRC understand that entities with low levels of VAT to reclaim, input tax, and high levels of VAT to pay, output tax, may charge VAT on sales and then fail to account for the VAT to HMRC, and instead abscond with the VAT. To put this into the context of our example, subcontractor 1 would charge VAT to subcontractor 2, but instead of accounting for the VAT to HMRC, would then retain it before disappearing as what HMRC refer to as a missing trader. HMRC intend to introduce the DRC to remove this risk. After the 1st of October 2019, suppliers of certain types of construction services will not be required to charge and account for VAT on those services. In the supply chain we looked at earlier, this will mean that subcontractor 1 will raise an invoice for, say, £100 to subcontractor 2. However, subcontractor 1 will not charge and declare £20 VAT as output tax to HMRC on its VAT return for the relevant period. Rather, subcontractor 2 will include £20 as input tax and a corresponding entry of £20 output tax on the same VAT return. Assuming subcontractor 2 is entitled to full VAT recovery on its costs, it will be in a nil net position in respect of its purchases. Subcontractor 2 will then charge £500 for its services to main contractor and raise an invoice to main contractor for £500. As with the previous step, subcontractor 2 will, in turn, not charge and account for the £100 VAT as output tax to HMRC on its VAT return for the relevant period. Main contractor will instead include £100 as input tax and a corresponding entry of £100 as output tax on its VAT return. Again, assuming that main contractor is entitled to full VAT recovery on its costs, main contractor should be in a nil net position in regard to its inputs. Since the developer is the end user, it should provide the main contractor with a written confirmation of its end user status. This will enable the main contractor to then charge £1,000 plus VAT for its services to the developer or end user and raise an invoice to the developer for £1,000 plus VAT. Main contractor will declare the £200 VAT as output tax to HMRC on its VAT return for the relevant period and assuming developer is entitled to full VAT recovery in its costs, developer will in turn recover the £200 VAT as input tax on its VAT return for the relevant period. This change achieves the desired effect of removing the risk of parties being able to charge VAT and fail to account for it to HMRC. However, it also has the potentially unintended impact of removing much needed positive cash flow and therefore working capital from the supply chain. While it is possible that subcontractor 1 is a fraudster seeking to charge VAT and fail to account for it to HMRC, in my view, it's significantly more likely that subcontractor 1 is a small or medium enterprise operating on very narrow margins. If this is the case, then the VAT that subcontractor 1 currently charges may well provide it with significant working capital, i.e. up to 20% of its turnover, between the time it receives the payment from its customer and the time that it is legally required to account for it as output tax to HMRC. Just to expand on that, if subcontractor 1 raises an invoice on the first day of its VAT period with payment terms of, say, 30 days, and receives the payment in line with those payment terms, then it should have access to the VAT as working capital until the VAT return and any payment is due to HMRC. Typically, this is the 7th day of the second month after the period ends. This may well be vital working capital for subcontractor 1. The issue is then replicated for subcontractor 2, with any potential cash flow benefit of a reduction in delay on the recovery of input tax outweighed by the cash flow disadvantage of foregone output tax. Provided the end user has issued an end user confirmation to the main contractor, the main contractor should charge an account for VAT as usual. The key points to understand, therefore, are which services the DRC will relate to and how an end user is defined. The services covered by this change are broadly those services that fall under the construction industry scheme. HMRC's updated guidance issued on the 7th of June 2019 has clarified that this will include supply and fix works. For example, we now know that a joiner constructing a staircase off-site, then installing it on-site, is making a supplier of a reverse charge service, even if the charge for installation is only a minor element of the overall charge. Further, HMRC have stated that if there is doubt as to whether a type of work falls within the reverse charge scheme, as long as the recipient is VAT registered and the payments are subject to CIS, the reverse charge should apply. However, HMRC have also confirmed that reverse charge will not apply to employment businesses who supply construction staff. HMRC see this as a supply of staff by their employer and not supplies of construction services by the workers themselves. The important distinction between supplying staff and supplying construction services from HMRC's perspective is that the individual workers are employed or paid by the employment business and not by the construction business that uses them to provide construction services. This seems a fine distinction to me, and one where I think that there is scope for mistakes and potentially abuse. It is clearly crucial to understand whether supplies of qualifying services are being made to an end user. HMRC's updated guidance states that where the customer status is not clear, the supplier should ask the customer if they are an end user or intermediary supplier, someone connected with the end user, and keep a record of the answer. It is the responsibility of the customer to make the supplier aware that they are the end user or intermediary supplier, meaning that the reverse charge does not apply. However, in my view, HMRC have inadvertently created the possibility for errors by stating in their updated guidance that sometimes it may be obvious that the customer is an end user. For example, if there is a repeat contract or where sales contracts are clearly set for consumer sales, so it will be acceptable to charge VAT in the normal way. I do not think that this is helpful and again creates the potential for errors or abuse. Allowing a supplier to make a decision in the absence of an end user confirmation creates a risk that services could be treated as subject to VAT when they should have been treated as subject to the reverse charge. HMRC's guidance reiterates the fact that there will be a light touch in the first 6-month period following the implementation, provided the business is trying to comply with the legislation and has acted in good faith. However, HMRC says it may assess for errors during the light touch period, restricting penalties to cases where they believe the business is taking advantage of the measure by not applying it correctly. Where an end user has not provided written confirmation, resulting in the reverse charge being applied incorrectly, HMRC will expect the customer to notify the supplier that it is an end user and request a corrected invoice. However, in the absence of an end user confirmation, the main contractor is required to treat its suppliers as subject to reverse charge, and you will see that there is a clear temptation for the end user not to issue an end user confirmation and generate a cash flow advantage for itself. We would strongly recommend that end users do not seek to manipulate the new rules to obtain a cash flow advantage, particularly given HMRC's comments in respect of a light touch approach. In a sector where margins are tight and payment terms are fiercely negotiated, we anticipate that the reduction in working capital at all levels below main contractor will have a significant impact throughout the supply chain. As you can see, there are a number of practical aspects to bear in mind, and we should be pleased to arrange a call to discuss these separately if they are relevant to you. To conclude, in the short term, the DRC will increase the administrative burden faced by businesses in the construction sector, and it will have an ongoing impact on working capital in the sector. HMRC are aware of the risk to the supply chain posed by the impact that the DRC will have on cash flow and working capital, and their response has been to point out that there is a significant lead-in time to implementation, and therefore those affected have time to find a solution. It is not clear to me what easy solution any business would have to finding an alternative source of funding equal to up to 20% of its turnover. Therefore, while the main contractor will doubtless have commercial reasons for maximising its own working capital, it should nevertheless be aware of the increased stress that its subcontractors will be facing. There may be need for main contractors to work closely with subcontractors to agree payment terms that ensure that the risk of any negative impact from the DRC can be as closely managed as possible. I strongly recommend that any business impacted by these changes follow the position closely and seek advice on what steps they need to take to remain compliant and manage the commercial impact.